We are going to jump to our next session, it's going to be moderated by Nigel Douglas from Douglas Funds Consulting, and we're going to be touching on the topic, times of change, global growth. And this is what I spoke about earlier, the need to be thinking about things differently as we are moving into a new era. Nigel.
This session is about change and portfolio management in times of changed global growth. Now, as we've heard from a full range of speakers today, change is a constant challenge and opportunity for active asset allocators in constructing efficient managed account portfolios. Now, we tend to think of things as change accelerating. You know, we're hearing about artificial intelligence, drones, and it all sounds good. But sometimes change can go into reverse. I mean, who would have thought we'd have a large-scale trench warfare in Europe again in the 21st century, in 2024? And on a more prosaic basis, I mean, office REITs and railways are still areas that attract interest and aren't associated with those more sort of aggressive growing areas, such as artificial intelligence. Now, we're going to be discussing change today, and I've got two experts with me in different dimensions. We're going to be looking at cyclical economic change and how you think of that, structural changes, and I guess mega trends, which is a very popular word. So we have two speakers who are going to give short presentations each on this topic. Rebecca Jacques, who's the Head of Portfolio Solutions at Mercer Wealth, and Monik Kotecha, who's the Chief Investment Officer at Insync Funds Management. So Rebecca, if you can come up and start your presentation, and then we'll have a Q&A.
Thank you, Nigel. I'm not sure what the expert means, if that's a reference to my age, but anyway. So if we look at it, and to Nigel's point, right, we tend to look at the very first premise when we start to build portfolios, effectively what are some of the themes and opportunities that are going to start to impact portfolios. You'll see on the slide we sort of bucket it into sort of three areas, and a nice way of putting it is sort of regime change to us is that sort of one-off but indefinitely persisting paradigm shift, right, in conditions. So it tends to be not so much short term, but it's certainly sort of here on the horizon today, basically. Then you look at sort of super cycles, which we tend to think of those as conditions that will outlast multiple market cycles. So, how do you look at capturing on those opportunities? And then, as Nigel touched on, this concept around mega trends, right? So they typically are much more longer dated in duration of how they're going to last. And also, how you might look to play them out. So I think no different to what you've already heard today, we continue to sort of see this upheaval across global markets, economies, society, all the rest of it, right? And what that really is partly coming about because of obviously this normalisation of monetary policy, escalating conflict risk, the disorganised transition to cleaner technologies and what that means for industrial processes, and then that sort of concept around AI. And for us, what that means is we classify or talk about it as that we're now in the age of agility. And what we mean by that is that this must now become the foundation for how investors not only take but also make decisions. So you've got to, the way to, these sort of buckets, for want of a better word, help us to, build some structure around decision making so that we can understand those key trends and how they play out in markets. So just if you pick up on the regime change, right, and I'm only going to touch on it a little briefly for each of the sort of concepts. The very first thing that you start to see is the flattening of the risk, the efficient frontier, right? So this changes immediately and sort of starts to have several implications for portfolio construction. What it really does is it's now sort of saying to us that the incremental return for taking on more equity risk is becoming smaller, right? So, you know, at that point you can sort of go, logically, you can go, well, I can build a portfolio with a higher Sharpe ratio, tapping into more efficient types of returns from fixed interest, right, than what I probably could have got 2 or 3 years ago. There is, though it's not just quite as a linear, it would be lovely if it was just a one-way sort of story. The challenge is, though, that the defensive role that fixed interest has traditionally played is probably not going to be as strong as it's been in the past decade. And this sort of comes about because of that regime change where if inflation it sort of is more volatile, then you tend to see the equity bond correlation being often more positive than negative. Right? Doesn't mean it's always going to be positive, it just means we're going to go through periods where that occurs. So if we look at it at that very base level, you can see that what it does for us is we go, you need to, if you haven't looked at your strategic asset allocation, maybe is now the time to start looking at it. Because maybe you don't need as much equity risk on the table to achieve the same sorts of returns that you previously were. But also, if you need that sort of capital preservation and you need that portfolio to work cohesively together, then maybe some of those effects that you're hoping for the defensive qualities in fixed interest may not always be present, right? So you can see automatically how that leads to then how do you look for opportunities in that area and what you do with it. If you go to sort of this more sort of super cycle, right? So this is things that are not going to impact us immediately on day one, but this concept around energy modernisation. So I'm sure many of you are all familiar with OPEC. There is now people talking about OMEG, right, which is the Organisation of Metal Exporting Countries. And it's really because if you look at the energy transition process, right, so if we take EV cars, for example, whilst they generate around half the lifetime emissions of their sort of ICE counterparts, they require 6 times more minerals to operate, right? So suddenly what you're going to start to probably see is that some of the metal-producing countries are going to exert more power on that sort of global arena. So is it out of the ordinary now to think about that maybe they may collectively get together to become more organised? And does this present more opportunities for those sort of countries if that's the case going forward? Now, you know, as I say, it's not without the realm of possibility. It certainly hasn't happened yet, but, you know, they're the sorts of things that we sort of look out for. If we then turn to sort of a mega trend, and interestingly enough, the mega trend in some respects it gives us opportunities all the way through that sort of cycle. And what it really is where there's divergence in risk, right, it creates dispersion and dislocation. And that dispersion and dislocation then presents opportunities for agile managers, right, who can capitalise on these. So what does that turn into? Well, it gives us opportunities that we can now look to exploit, you know, by getting broader mandates in credit, right? You know, things like that where you can give managers greater flexibility in multi-asset credit or credit opportunities. The forgotten sort of poster child from probably 15 years ago, this is probably leads to our heritage, right? Hedge funds start to come back into their own, right? They've not been able to deliver for, you know, in excess of sort of 10 years, but now is this sort of environment going to suit their needs more? Private markets, I know people talk about it ad nauseum to death, so I'm not going to dwell on it. But even the dislocation and dispersion that we're used to seeing in private markets, that in itself is also going to create even more opportunities, right? So I'm going to sort of wrap it up there because I think I've already gone over my 5 minutes. But this just sort of gives you an idea at a broad level how we start to think of those themes and think about how they play out in a portfolio. So thank you.
Okay, I think it's become fairly clear now that it's really important to identify regime changes in economic conditions. And certainly as an equity investor, it's also important not only as an asset allocator, so even if you've got a specific style, whether it's value, growth, whatever it is, you need to understand the environment you're operating in because they do tend to last for a long period of time. So if you looked at the period post-GFC, if your portfolio was chock-up full of value stocks, well, that hasn't worked out very well for a very long period of time, right? So, as a value manager, if you're a value manager, you need to think very clearly about the conditions. So we've had various conditions over time. We've had the great inflation period in the 60s and 70s. We had the great moderation period, which was much more stable. So you can have a buy and hold. As an equity investor, you can buy and hold stocks for a long period of time. Then you had the pre-GFC period, the post-GFC period, now you've got the post-COVID period. So all very, very distinct periods. And understanding each of these regimes is really important because they come with varying levels of economic uncertainty and market predictability. And this clearly has an impact, as Rebecca suggested, has an impact on risk management, on asset allocation. And certainly for equity investors, it is important because, for example, in the period of great moderation, when things were very stable, you can have a buy and hold strategy for a long period of time. Whereas now, if we are moving, which it appears as if we are into a period of greater uncertainty, then you need to be, again, I think the words used was agile. You do need to be more agile. Even myself as a manager in global megatrends, I need to be quite thoughtful about other factors. I can't just blindly say I'm going to buy and hold this forever. So as I said, I think understanding regime changes is absolutely critical, but they are difficult because they happen very infrequently. And so you can get stuck in a mindset for a very long period of time and not actually notice that it's actually occurring. So they are very difficult sometimes in terms of identifying, in terms of turning points. So I think previous speakers, I wasn't here for all the earlier speakers, but I'm perhaps repeating some of that, but clearly the investment regime appears to be changing now. It does appear that we are now moving into a environment where inflation is going to remain volatile and higher than what we've experienced in the pre-COVID environment. And obviously, as a result, interest rates will probably be higher. I think there are three reasons, certainly from my perspective, why that will remain the case. It's obviously a very aggressive fiscal expansion is one. The other one is obviously the protection of supply chains. So you're not going to the cheaper supply chain anymore. So that's going to, and the third one is labour. Interestingly, just come out data in Australia that the unemployment rate's actually dropped to 3.7%. Right, so we've had record rises in interest rates all the way through last year, and logic will tell you that we would have had a hard landing by now, and unemployment rates would have skyrocketed where we haven't seen that. So what's actually going on? Okay, so it's a very, very complex picture out there. There's obviously been a lot of discussion around geopolitics. I won't go through that, but obviously there's going to be a lot of diverging policies between regions and countries now, as opposed to a harmonized policy. And I think the other important thing, which I think is a big deal, and it is accelerating, is the unprecedented level of disruption, and I'll touch on that in a bit more detail shortly. So what does this mean? I think in terms of for stock pickers, this is very, very positive because I think the dispersion of returns certainly now are going to be much greater, both across stocks, sectors, and geography. So, for example, in the last 7-8 years, I mean, I've been to so many meetings about being underweight US and overweight Europe now, consistently for 7 years, and how wrong has that been, right? Emerging markets, you've seen the divergence in terms of performance between China and India, okay? And there's clearly been a regime change in China, right? So why wasn't that picked up a bit earlier? I mean, it was clearly happening, okay, and it had a profound impact. So I think this is a great environment for stock pickers. And I think dynamic portfolio management is certainly the key. You've got to be mindful of valuations. So even myself, who looks at long-term trends and looks for great businesses to participate in those long-term trends, but certainly in our process, we try to be very vigilant around valuations as well and what we're paying for those companies, and being quite active around it. So, it's a simple buy and hold strategy across asset classes or across stocks is no longer going to work in the same way that it did previously. So AI is a big deal. It's going to be a huge market. Estimates looking at 10 years, it's already growing, by the way. I mean, you just need to look at NVIDIA's results, regardless of what you think about valuations. But those are real earnings and cash flows, not eyeballs like it was during the internet bubble. And that, its estimated size is going to be $1.3 trillion. So look, there are going to be bumps along the way. There are going to be periods of exuberance, but it is the real deal. and it's going to be transformative. I mean, that's what Bill Gates has basically said is the most transformative technology in his lifetime. So I think it's quite a profound statement to make, and it's going to impact various industries. It's going to impact the healthcare industry, finance, autonomous cars. Klarna. This is probably the first and best case study that's come out recently. Klarna, which is a buy now, pay later. The big players, particularly in Europe and in the US, they've got a deal with Amazon. They came out and they've just said that the AI assistant they've introduced has done the equivalent work of 700 people, and they've had 2.3 million conversations so far, and they think it's going to save them $40 million this year. Okay, I mean that's an extraordinary number. So you can see the impact already starting to have an effect. The other one is the other big disruption, massive disruption, is the seismic changes we're seeing in demographics. So I think we're all obviously familiar with the silver economy and the aging population. That's actually accelerating today, and again, that's having an impact on healthcare spend. I mean, the average healthcare spend for an over 65-year-old is 3 to 5 times higher than anyone who's under 65. Okay, so that's definitely a mega trend, and it's accelerating. At the same time, within the next 7 years, the Gen Zers are going to be the largest generational cohort. They've grown up in a digital age. Their behaviors and consumption patterns are very different from any previous cohort of the similar age. They're very mindful and very thoughtful. They look for value for money. They're not so much into big brands, and this has an impact at a stock level. So, winners are starting to emerge, and you've really got to avoid the losers in all of this process. So just having a backward-looking process is actually quite dangerous. So understanding these demographic shifts is highly disruptive to lots of different companies and sectors. So understanding them will certainly help to generate alpha going forward. So we believe megatrends is certainly an attractive place to be in this environment, this environment of uncertainty and perhaps higher business volatility. One of the things megatrends do is that it does actually help to reduce the exposure to the more cyclical elements of the portfolio. Normally you find portfolios that have got quite a strong cyclical bias to it. And in fact, if you look at the correlation of returns between a portfolio full of megatrends and a portfolio full of the traditional sort of value growth style of investing, the correlation is actually a lot lower to cyclical indicators. So they are relatively, from a cyclical perspective or economic sensitivity perspective, they're much lower. The other feature is that you really are investing on a forward-looking basis here. As you know, a lot of investments are market cap driven, so they're backward-looking. And I think by looking on a forward-looking basis, you are looking at the future participants, what I call the future beta, index betas going forward. You are participating in companies that are going to be more dominant if you have a megatrend approach to investing. And the final point here is you're really, if you look at investing in a classic way, it's quite prescriptive in terms of sector allocations, in terms of style allocations, and I think sometimes opportunities are missed going forward because it's quite a narrow way of looking at it. I think what megatrend approach does, it kind of opens your minds up in lots of different ways, and you're picking up investments. And I think this is reflecting the fact that if you look at, again, the breakdown of returns on a traditional basis, most of those returns can quite clearly be seen and analyze and say, well, that's actually coming from this sector or this style buys, whereas when you actually look at megatrends, it's much more idiosyncratic. And I think that's very important from a diversification perspective. So just to finish off, this is the Insync portfolio. I mean, we've got 16 megatrends. You'll notice here that there's a blend of not only tech, which is important, I mean, but also there's a lot of non-tech megatrends here. So we've got the silver economy, the aging of the world population. You've got pet humanization. You've got the trading down trend, because there's certainly a bifurcation going on in the labor market where the rich are getting less richer. More of the middle class are actually getting pushed down. So we're seeing lots of opportunities in those companies that are actually catering to those shifts that are actually occurring today. And these are powerful long-term trends, okay? They're very large. They're unstoppable like a giant wave. And they've got large addressable markets they can grow into. And then, the skill really here is not only about identifying the trend, but it's actually working out when to invest, which stocks to invest in. It's a very specific approach. And then obviously when to sell. Okay? And I think the other feature here is, it's not about buying unprofitable stocks. You can buy stocks here, which is what we do, with strong balance sheets, strong cash flow generation, highly profitable, and highly innovative. Okay? So they've got all the attributes you want in a good business, but you're getting the benefits that I mentioned a bit earlier about. So with that, we're happy to move to Q&A. So thank you for that.
Okay, thanks Monik, thanks Rebecca. So we'll just move on to questions. I've got a few, but anyone in the audience with a burning question, just raise your hand and we'll get to you. So just starting actually with Rebecca, earlier we heard from Chad talking about global X's in investments in, or products following an S-curve and thematics. Monik's an active manager, obviously. So from the perspective of constructing a managed accounts portfolio, how do you think of combining active funds management managers with ETFs, to capture these trends, right?
Yeah, I mean, look, we work across the whole opportunity set where the platforms will enable us to combine the two. A lot of the managed accounts may have like cost constraints and things like that, which do come into the picture with it. So for us, we can, and it's not quite true, but we can be vehicle agnostic, subject to it's playing the way we want it to play. It costs what it needs to cost. It provides the liquidity that we need. And obviously we're aware of, all the variables that go along with sort of relatively listed things and all the rest of it. But we do use them in combination. So typically we tend to use more sort of ETFs at the index level, purely just because of the cost basis. Some of the active sort of thematic sort of ETFs can be sometimes quite expensive. And they're expensive to get right in terms of the positioning set in the portfolio.
I mean, there would be a fair degree of overlap in some of those thematic ETFs with some of the broad-based active managers, right? Yeah,
and you have to be careful of that. So, I mean, that's what I'm saying, when you look at it and you look at like your core exposures or things like that, we tend to, like when I was talking about those trends, we actually look for those trends to be emerging regardless of whether it's a thematic play or not, but are they being picked up in portfolios, right? And that's like, if I just extend that a little bit, like one of the work, some of the work that we've been doing is around that sort of core equity sort of allocation. And you still get a lot of managers in that space that say, I don't understand tech. Well, we sit there and go, well, okay, tech's been in this market now for 20 plus years. So you can't be a core manager if you don't understand tech, right? So you have to understand it in some way. So we remove them from the portfolio, right?
Right. Okay, good. Okay, now Monik, having been in the markets for a while myself, old style thematic managers were, it was a phase, and I guess broadly they were called top down. And so it really brings me to the question, like the way that you're investing in mega trends. How do you sift through, they're quite broad, those trends you talked about, obviously. But how do you sift through the trends to find companies, that are good and bad to take advantage of that trend investing?
Yeah, good question, Nigel. So you're right; they were very broad, and I think I think the problem with thematic ETFs is people kind of identify the theme and just throw money at the whole theme and assume that all the stocks that are participating in that trend will go up. And research actually shows, if you go back last 100 years, that it's only 4 or 5% of all stocks that actually outperform over the long term. So you can't have every stock in a theme performing well, right? So I think the key there is, as you said, themes are quite broad, and you've got to work out what are where the economic benefits definitely going to come through from, which is why we, the broad themes are, technology, demographics, decarbonisation, but you can't just make money out of that. We've only got one stock in decarbonisation. Love to have more. It's a fabulous theme, but there's only one stock that actually hits our metrics. So what you've got to do is you've got to there's a couple of steps involved. So first of all, you've got to identify, the trend. You've got to work out how large that trend's going to be. Where are you on that trend cycle? Because if you're too early, then there's a risk, because there's a lot of money that's going into that trend very early, and there's a chance that a lot of companies won't make money. So you've got to be on the exponential part of the S-curve, as they say, not at the early part when it's still forming. And then you've got to find the right company, and there you've got to use the classic skills of bottom-up investing. So you've got to look for good companies, which is what we do. So that's why I mentioned at the end, high levels of profitability, good cash flow, etc., etc. And then you've got to know when to jump off it. And through that whole process, valuation is also an important consideration, because from time to time, markets get enthusiastic and they get overextended. So those are some of the tools that we use.
Yeah, okay, great. Any questions from the floor? There's one down here.
Not so much a question, but an observation. I think you said, and that Gen Z, going away from brand products and not attracted to them as much. My observation was quite different. So I'm just wondering, is that a truism or is that just wishful thinking? That's just one question. And the other one, you just now said that you've only got one core stock of the carbonization part of it. That marries up with mine, because I read that ethical investments are not doing as well as they were expected to do before this.
Yep. Two great questions. So it's obviously, understanding Gen Z is quite complex. So there are, it's a bit like the broad market. I mean, there are certain Gen Zers who would buy when they spend money on the best, but they don't buy all brands. So in my generation, we used to go to Gap stores, and we used to go to, big logos on the shirts and etc. My observation is they don't like any of that. They don't, they're a little bit more discerning if they do spend money. Otherwise, they're highly value conscious. So when I look at my staff member, I look at my daughter, they're both very young. They're big into secondhand clothing. Okay, they're big into recycling. They're big into sustainability. Things that we find difficult to associate with because we didn't grow up in that environment. Because that's ridiculous. It's not. It's really the way they're thinking. There's 2 billion of them, okay, thinking that way. So when you're thinking about potential winners of the future, you really need to be analysing the Gen Zers very closely and observing exactly what they're doing. On your second question, I think that's exactly right, because I think that the theme is very exciting, but it's about finding businesses that can deliver sustainable earnings growth and high levels of profitability, and that's not that evident at this stage within the decarbonisation space. So, we keep looking. I'm sure there are other opportunities, but they are hard to find.
Okay. I've just got a closing question for Rebecca. Now, these mega trends can take a long time to play out, and as we know, clients don't have a lot of patience, particularly if short-term returns are underperforming benchmarks. So, in running a managed account portfolio, what sort of levers can you pull in the short term to, keep investors confident that the portfolio is heading in the right direction?
Yeah, there's a couple. I mean, we at Mercer do employ DAA, but I would put a caveat over it. It's certainly
tell people what DAA is, just in case.
Yeah, well, so dynamic asset allocation, right? So it's not tactical asset allocation. So it's not like if we think the market's going to tank tomorrow that we can pull everything out into cash, because the reality is you can't. So then what we have to do is to your point, we drill down, right, and look at how do we employ managers to assist us with that sort of need for speed as well. So we do put in some sort of, like, particularly idiosyncratic sort of alternatives to help move those levers around a bit. The challenge you've got is, depending on...
So what's some examples of those?
Well, so they're sort of your multi-strat idiosyncratic managers, right? The challenge you
Hedge funds?
Yes, yeah. And the issue that unfortunately we come to bear on those sorts of things is that they will either, take a lot of beta or not take it, but because they're moving that beta on and off the table at any given point in time. But it can be used as a lever to help assist, right? Because it's very difficult to get in and out of strategies as fast as you want. The other way that we do it is we break down each of the sub-strategies as much as we can. And, you know, like if you look at what we've done a lot of work on fixed interest portfolios because, you know, if you go back 5 years ago, you didn't get the granularity that you now have. And so we start to play those levers a little bit more. And you still want to give them, I mean, the mandate breadth we give them is to try and let them play the space, right? We don't just go, well, we want, you know, credit. Well, we want multi-asset credit. Play the whole depth of it because we can't get in and out. We do the same with duration. You know, we can't go short or long and choose. We want you to use that lever. So it's understanding the limitations of it. I mean, we always talk of, you know, the sort of DAA concept, but
you've got to be reasonably active at a strategic asset allocation and a tactical or dynamic asset allocation level, and picking the mix of active and passive as well. Okay, I think we're out of time, so I'd like to thank Rebecca and Monik.